and welcome to another exciting episode of Finance Footnotes. I'm your host, Brent Stransky, joined by my friend and colleague, Zach Miner, as usual. Today is January 7th. This is an important podcast. It's our first of the year. We're going to unpack some of what happened last year and also look ahead, see what the predictions could possibly be for 2025. I think it's an important podcast. We're going to, as usual, go a couple layers deeper into the onion to help you hopefully improve risk-adjusted return. So it was a great year, Zach, and I want to just point out a couple things here where we are in terms of the marketplace as of yesterday. This slide is from the Wall Street Journal, and you're seeing that it has been a little choppy here in the last, let's call it, 5 or 6 weeks, but markets remain near all-time highs. The S&P 500, which is the broadest measure of the index, is about 2% from all-time highs. The Dow, which is less representative, is off a little bit more than that. So want to just take a moment to reflect on a great year. Zach, you and I last year at this time had a podcast, and we kind of highlighted, Barron's magazine does has six professionals come in and prognosticate as best they can every January. And the average for those six was 2.8%. So that was January a year ago, 2.8%.
Yeah.
Then these are smart people with many followers that are paid a ton of money, right? Very, very wealthy people. You and I were much more optimistic than that, and it proved to be the right call. So S&P 500 up 25%, highlighting that has a 34% tech weighting, because the S&P 500 equal weight was up only 11%, which we've talked about that before, Zach, but it seemed low to me. What do you think?
Yeah, I mean, it was just driven by the market cap, the highest market cap companies, and the generals were leading certainly. And you can point to that as a potential point of concern, right? If the rest of the market isn't participating as much as the leaders, you could also look at that as an opportunity for the rest of the market to catch up. So I think we've talked about that a little bit before. So
this is like that famous quote about the two-handed economist. On the one hand,
yeah, you can definitely look at that in either direction, but it wasn't like the rest of the market was down, right? It wasn't like things were, it wasn't like you were necessarily masking weakness. It was just that the best companies did the best and the rest did okay.
Yep. Yeah, it's certainly okay. I mean,
And not even okay, right? I mean, but more than the average annual return, right? So it wasn't like it was, subpar.
very attractive. But it's just highlighting something you and I talked about: concentration of the Magnificent Seven, top 7 tech companies, something like a 35% weighting or so at the moment. They all did exceptionally well. They all drug up the index, and it's just, if you had, what is that? I don't want to do the math here on the fly, but maybe 0.2% in each position of 500 positions gets you to 100%. And that's, that is what the S&P equal weight is. And that's up. So compared to the Dow, up about 15%, NASDAQ 28%, small caps 10%. They really slid off, surprisingly, are down since President Trump was reelected. And then international stocks, I knew they had a bad year, Zach. I was kind of surprised to see up only 3.3% for the year. And another bad year for bonds, right? 3 of the last 4 years have been ugly for bonds. So up only 1.3%.
Longest bond bear market in history.
It's
still
it's wild.
Still in the drawdown.
It's wild. So those are the first 6 indexes. I highlighted the next 3 in blue because I want to highlight them. These are kind of like benchmarks, right, for folks at home keeping track of their portfolios. One asset class did really well. It's the asset class everyone talks about. It's done really well for 2 years. That's the U.S. large cap S&P 500. Small cap did less so. International did not great, and bonds were not good. So a conservative allocation, according to Morningstar, up 6.6% in the year. Moderate allocation up 7.9%, Zach. And then a growth allocation, which would have a small amount of bonds, but a heady, part of international stocks, up only 10.7%. Which is, hey, that's what small caps did, not too far from what the equal weight did. But I just want to highlight the fact here that I saw something in Twitter. Maybe you saw this too, X, and it was talking about Charlie Bello, and he said, according to Goldman Sachs data, the average investor had done 9.7% compared to 25 for the S&P. So that's someone who's a growth-oriented investor. So I think just something to highlight here as we go forward. Most investors by far aren't taking the S&P 500 as the index. Zach, what do you think about that?
Yeah, I mean, and I'm sure you know, in talking to clients, they see the S&P, right? That's what they see, and then, kind of rightly or wrongly benchmark their accounts towards that. Um, where did those allocations come from? That's from Morningstar, you said?
Those are the iShares. Like if you do the iShares,
Oh, gotcha.
those are broadly used
Okay,
indexes, with billions of dollars. So it's just one benchmark. You can go to Vanguard or others, but that was
gotcha.
just the just one option there for folks to take a
Yeah, I
look at.
think
So
at least in kind of across our universe, because I kind of get to see what everyone else is doing, and I think for the most part, the growth portfolios were in the neighborhood of 15 to 17, something like that. Largely because they're a little overweight to large cap US, they're overweight to US in general. Um, I wouldn't necessarily say 10.7, but very few portfolios did 25, right? Like, if you had a diversified portfolio, you didn't do that. So it's important to look at the rest of the components, in your portfolio and benchmark them appropriately.
yeah, I'm just looking at the VNQ here, which is a major benchmark from Vanguard on U.S. real estate, which is another allocation, in portfolios up, geez, 4.81%. So there you've got
Right.
yet another example, Zach,
Yeah.
to kind of bolster our discussion there. So just highlighting what has happened in the past there. Going forward, okay, that's what we're here for today. Try to look at what's going to happen going forward through the looking glass, as it were. Saw an interesting tweet here, and I added LPL, but this is 16, including LPL Financial, which is our broker dealer, the largest independent firm in the country based on assets. Um, anyway, so there's 15, and it's interesting. I created this chart. What the firms do, Zach. I think it's funny. They kind of give a target for the S&P. They don't tell you what they think the S&P is going to go up as a percentage, which is what everyone wants to know. They give you a target, and
Right.
so you see Oppenheimer here at the top, Wells Fargo, Deutsche Bank, etc. So they're ranked by what their highest target is, and then what the equivalent percent return would need to be to get there. Okay, so that's on the right hand side there. And so what I thought was interesting, just two quick highlights, Zach, then I'll open it or get your thoughts here. But I highlighted in red here what I believe are four of the largest: Citibank, Goldman Sachs, J.P. Morgan, and Morgan Stanley. Those are four of the largest, I think, and they all have the exact same. They all have
Right.
the exact same target on the S&P, which is 8.8%, which, as we've discussed before, is basically no prediction at all, since that's exactly what the market's done, basically for the last um, 50, 75 plus years or
But
so.
but the interesting thing is it almost never actually does that, right? It
No,
either
this
goes
is
up
like
25 or down 15. Like you're never at 8 or 9%. So you're right. It's like a non-prediction prediction.
this is a very safe bet, right? I see you say something like 80% of the time the market's it's above this or something like that.
Yeah, definitely.
Anyway, so UPS did not predict what's going on. UBS and BNP, and finally LPL Financial. I was really surprised that compared to the other 15, LPL is second from the bottom at 5.4% on their
Yeah.
much more conservative expectation here for U.S. stocks from LPL Financial.
Yep.
So take that for what it's worth. The average is 10.3%. Um, yeah, I thought this was really interesting. I mean, you'll see from 0%, no one ironically predicting a negative return this year. Cause for
Uh, so
concern?
so there actually is so First Trust. I don't know if you follow them at all. And I bumped in my because I had a very similar slide with some of the same things on here. But I put their 2024 ones on here
Oh,
also
so
to see
good.
what
So
what
great.
their what they guessed in 2024, and they were all drastically underestimating the market returns, which does give you pause, right? Because if they were so
Mm.
wrong in 2024 on the downside, you wonder, well, now they're all positive in 2025. Does that signal that they're going to be wrong to the upside?
This is great.
Um,
Your slide shows 2024 predictions. Like, hey, how right were you? And you can see that there were three: Wells Fargo, Morgan Stanley, J.P. Morgan were negative last year. I forgot J.P. Morgan. J.P. Morgan, the nation's largest bank, thought the stocks market would be down 11%. Wow.
4,200. Yeah,
Oh my
incredible.
gosh. What a
Um,
miss.
but so
But
First
there's the
Trust,
biggest, smartest people, by the way, folks.
yeah,
Smarter and better paid than Zach and I.
yeah. So First Trust does actually predict a negative return. So their target was 5,400. I didn't get a chance to add it
Okay.
to here because I just saw it yesterday. Um, but yeah, their target is 5,400. So you figure our year end was what 5,975. So that's a nearly 10%, 8% decline that they're
First Trust,
forecasting.
major firm, major large firm, kind of not often seen there in marketing, but certainly in our industry. Well, we can look it up, but they're probably, I
Yeah,
think they're a top 10 manager, Zach.
maybe. But
No,
they're well
big,
known. Yeah, they do a
big
lot
enough
of
to pay attention to.
yeah, big enough to pay attention to. And but again, they were pretty drastically wrong in 24, right? They were cautious last year. I don't know if they were predicting a negative return last year, but certainly not a double digit positive return.
Hmm.
So the one guy I do highlight on here, and in my quarterly letter coming out, I highlight Yardeni research. So Ed Yardeni,
Hmm.
he was the most right in 2023, had
Yep.
predicted significant upside returns when again most were not. And again in 2024, he predicted a 13.8% return, which
Second
happened to be
highest
still
of
10
the,
points off what it actually ended up being.
but
But
meaningfully higher than the average, double what others
meaningfully
were
higher.
predicting.
And if you look at him in 2025, again, predicting a 20% return. So
Wow.
does
Wow.
that, he's the one
Incredible.
of the last 2 years that has remained positive and is continuing to be positive. So
Yeah.
interesting to see. It does give me pause that they're all, with the exception of UBS, at a double digit return now. And it's like, okay, well, is that just the capitulation that they're you know don't want to be drastically underestimating or underestimating the
You got to
returns
play it
again?
safe
So
when you're taking care of those things. So that's a great part about Eddie Yardelli. He's really worth watching, and he's really been right the last couple of years. So we'll see if he's
yeah,
right in 2025. Okay, well with that explanation as to how right and wrong the smartest people in the room can be, let me go out on a limb here and make some predictions.
yeah.
I want to start by giving this great. I always know this quote. I didn't know it came from Niels Bohr, who's a Nobel laureate in physics. Prediction is very difficult, he says, especially about the future. Agreed. All right. Um, so I just wanted to quickly move on here. What do I think? And again, this is not written in stone, but I'm more optimistic than that average of 16 financial institutions. I believe there's at least an 80% chance that the S&P 500 will be up 12% or more. And I've got three reasons I'm going to share with you why I think that's the case. Followed Zach, I'll seed it here. I try to include one reason why I think things could go down to turn into a reason why things can go up. And then my second guess for the year is there will, in fact, be a 10% or greater correction. So I think there will be some chop coming here down the road. There wasn't a 10% correction in 2022. On average, there's one every
Yeah.
2 years. So I think we're looking at some volatility this year. Hopefully, it won't shake folks too much, but that's what I'm thinking here. We'll have to come back this time next year and see if I was anywhere near what happened. But I'm going to share three reasons why I think this can be the case here. First reason, and these are all from Carson Research, but I think they put out great data. Um, First is pretty simple. This is just about momentum. There have been a number of times where the stock market since 1950 has been positive 20% per year, 2 years in a row. And we talked about it last month. Four of the last five times were positive. So that's 80% of the last times have been positive with an average return of almost 16%. So this is just about momentum. This is just saying there's been a lot of energy in the markets. And historically, four out of the last five times, 80% of the time, the market has improved and meaningfully, very attractive, very attractive.
And
So that's
really
just about,
interesting that, what, one, two, three, four of those times were all, it was one stretch, right? It's 1995 to 1999.
mhm.
Um, and so, we've talked about momentum before and how it, outside exogenous shocks and things to stop it, market inertia is very powerful. And you don't know when that thing is going to come, and you don't know what that thing is. It's the
Mhm.
unknown unknowns, right? It's the thing that's
Mhm.
just out there that comes out of left field that puts a stop to these, uh, generally puts a stop to these bull markets. And so you could have been sitting there in 1996 saying, "Man, market's been really running here, right? I mean, we're up 30%, 25% in 3 years, 3 years running," and you're like, maybe it's time to get cautious. Well, you would have missed out on the next 120% of gains. Now, in 2000, that, obviously we know what happened, but these things can persist much longer than you think they can or should.
Yeah, and then maybe that's one of the things that Ed Yardeni is picking up on as well. So the first one's simple, just about momentum. The second reason I think stocks could continue higher in the third year of this bull market is that the Federal Reserve is cutting rates as the S&P 500 is within 2% of all-time highs. That's happened 20 times in the last 45 years. 20 for 20, the market was higher 12 months later. Okay. That's a pretty decent subset of information. Higher 20 for 20 with an average of 13.9% return in that 12 months afterwards, with a median of about 10%. So I think this speaks to the momentum in the marketplace, which we just spoke about, but I think it also talks about the easing of Federal Reserve policy. Now, there's been a lot of data around that in the last couple of weeks of December, but the Federal Reserve is undoubtedly still in an easing phase. So this could lead to further growth as the optics for the financial markets continue to improve. So I like this data set, 45 years, 20 observations, Zach. Did you see this? I think we talked about it last time.
Yeah. Yep. It's a direct economic, kind of indicator. And like it's another 100% hit rate, right?
Yeah, watch out for 100% hit rates. The past is not prologue. Third and final reason I want to share with you why I think stocks can power higher. We had some bad breath, not bad breath, bad breath at the end of the year. There were 14 days in a row where declining stocks outpaced advancing stocks. Okay, so a mouthful, but to put it in a more clean and digestible fashion, the Dow Jones was down 9 days in a row at the very end of December. It's a very unusual occurrence to have such a long stretch of declines, not intermixed with some small gain. And the 10th day was actually up just very, very fractionally. Okay, well, that's happened 7 times. Gosh, it's only happened 7 times since 1945, Zach. Holy cow.
Yeah.
Um, uh, higher 7 or 7, higher each of those 7 times with an average return of 18.7 and a median of 11.4. So I think this could be another uh, opportunity for stocks to continue to grow into the next uh, 12 months. Okay, so we'll watch that and see what happens. There you have it. The 3 reasons why I think stocks can go higher. We talked about the 9-day losing streak. We talked about the Federal Reserve cutting at all-time highs, and finally, we talked about back-to-back 20% returns. I think those ideas are as good as any others you're going to see out there. I wanted to intermix. I saw some things on Twitter, Zach. So this goes to my point that was supposed to be a negative point about the markets, a risk going forward. And I was seeing on Twitter that, some consternation, and actually this is in the Wall Street Journal, and I think about it. It was talking about how fund managers, money managers have the lowest cash exposure, in recent history, in mid-term history. Typically, that means that investment advisors, the smart money, are all money's in, right? So I wanted to kind of build around that. And I was searching for, what percentage of the investment money managers have a cash position, right? And I came across 2 charts here from the St. Louis Federal Reserve Bank that kind of contradict that theory. And the first is, and I was really surprised by this, Zach, and I love your feedback. Um, on the slide right now, I'm showing you a graph from the Federal Reserve over the last 10 years, and it's showing you the amount of money in money market accounts, okay? And you can see that it's a constant growth up and to the right. And money market, the amount of funds in money markets have increased by 56%, $2.8 trillion since the end of COVID. I think there's been this discourse that cash on the sidelines has decreased over time. I've certainly heard that there's been record inflows into equities and ETFs and
Right.
stocks, but this can only mean that there's a growing amount of cash on the sideline from some other sources, or be that as it may. But if you believed a year or two ago that there's a bunch of cash on the sideline, there's even more now. I was
Right.
really surprised by that.
Yeah, absolutely. And I actually pumped because I had the same concept in some charts. So I
Okay,
bumped
great.
these two up here. So this first one was actually a chart we highlighted last year in our prediction show, and for a reason why that dips could be bought, right? Because there's cash available to buy it. And this was a reason why we were positive, at least I was positive, to say that there's kind of tinder and kindling available, should the market present an opportunity to buy, and it was 5.5 trillion right at the time.
Mm,
And so you go to look and say, okay, well, has any of that been bought down? And the next one is the same chart that kind of you showed of where it is today. And well, actually, no, there's another 1.25 trillion. It's 6.75 trillion at the end of 2024. So there's more cash than there was at the end of last year in money markets. And if the Federal Reserve does continue to cut rates, and their forecast is for 2 rate cuts this year, I think that the market, I think last was two or three. But over time, if they continue to do that, the relative attractiveness of these money market rates will go down. When we were at 5.25, 5.5% money market rates, that was very attractive. Now they're closer to 4.25, 4.25. If that starts to go down into the threes, well, then you start to think, well, okay, well that money needs to find a home at some point, because you'll get to that kind of break even rate where folks are like, okay, well, I'm not earning enough on this cash anymore. At 5%, that could be there for a long time. As that starts to drift lower, that money needs to go somewhere. Now
And
it could be spent into the economy for sure, right? But that bolsters consumer spending, which bolsters company earnings, right? Or it can be invested, which bolsters the stock market. So I think both of those things are reasons why, that you can look at this indicator as a potential source of buying pressure. And
so just kind of building on what you said, because money markets are attracting funds because interest rates are higher. But I just flopped in a slide here called M2 money supply,
yeah,
which just to the folks at home, that's cash that's available and liquid. So that includes money markets, but also everything other essentially than cash under your mattress, right? So CDs and checking accounts and savings accounts, et cetera. And it kind of telling the same story that even since 2023, there's been a build in cash, right? It's not quite the same level as the money market accounts, which have grown for obvious reasons, but the cash on the sideline has certainly not diminished, and only grown in the last 12 months, which I thought was really
and and
surprising.
and this was the source of inflation, right? I mean, the money, if you believe in the kind of that theory of money that inflation is always a monetary phenomenon, well, then as the money supply increases, inflation increases. And the reason why it didn't increase with kind of quantitative easing back in the financial crisis, because it was given directly to banks that didn't necessarily lend it out. This time it was given directly to the people, in the form of stimulus checks and additional unemployment and PPP loans, forgivable, and all those things. So that money went into the economy directly, which increased the M2 money supply, which increased inflation. And if you kind of look through 2022 and 2023, M2 is stable to down and inflation is down, right? So it makes intuitive sense and empirical sense. Um, but you kind of look at this and see, okay, well, where did that money all go? And yes, a lot of it was spent, a lot of it made its way into the equity markets, but a lot of it is just sitting in money markets, trillions of dollars worth. Now there's a
And I think this is,
baseline, yeah,
you know,
there's a
I
baseline level of money market, right? I mean, it's not going to get spent down to nothing. You can assume that if you go back to like pre-pandemic levels of 3.5, 4 trillion, I think, right, is probably appropriate for just like a normalized level of money market. But we're at 6.75, right? That's
yeah.
$2 or $3 trillion of extra cash that needs to go somewhere at some point. Um,
So to build on that, I wanted to show just one other highlight. This is, talking the Wall Street Journal talked about money managers, and I found this data from the Federal Reserve, just talking about hedge funds, which also control a significant amount of money. But this kind of tells a different story, Zach. This chart shows that, over the last 10 years, since the Fed has been tracking this data for about 12 years, it's pretty steady, actually. It would be misleading to say that there's no cash, in the accounts of hedge fund managers. They've been about the same. It seems pretty steady over the last 10 years with some gyrations. So the 2 points I'm making here, and Zach's building on, is that there's kind of this colloquial, expression in the investment market that, the death of the bull market is when the final dollar from the final pessimist comes into the marketplace. And the data is just showing this can't possibly be the case with so much cash on the sidelines. People are keeping this cash because they're nervous about the future. So I think it builds into the thesis that there could be continued growth going into 2025 and beyond. And that's where I will end my comments and hand it over to you.
Yeah, no, I definitely agree with all that, and I highlight a couple reasons here for, similarly, why I think that there's some reasons for optimism. The first is that it's time for the earnings to shine. So we've had a lot of multiple growth. If you look, we've talked about valuations, about the expectations of these future earnings being filtered into stock prices and kind of ballooning multiples. And it's like, well, now it's time for the companies to deliver. And we've talked about these high bars that they're going to have to jump over in 25 and 26 for earnings growth. And you can see that the kind of consensus estimates is for 15% earnings growth in 25 and 13% in 26. I mean, you got to high double digits earnings growth for a mature economy is a lot, and they have to deliver. So I think that it'll be really important to watch earnings season throughout the year and see if they're hitting these marks. If they're not, we're going to see volatility because this is baked in at this point, right? Where multiples are. So it's time for them to put up, right, what we've been expecting them to do in these coming years. So I think that'll be something really important to watch. But there's no reason to suspect they won't really. Companies have been exceeding expectations continuously, and I expect that to continue at least through the first couple quarters of 25. We're not really seeing any reason to think
Yeah,
differently.
I read in Barron's this weekend that the average estimate for S&P 500 constituent company earnings in 2025 is 15%, which is incredible. That would certainly support earnings where they are, or the multiples where they are. So I think,
Yeah.
yeah, it's a great point.
Yeah, absolutely. And then you kind of look at just the state of things with the consumer and corporate kind of economies. And from a consumer perspective, that top right panel there is household debt service ratio. How much percent of your disposable income is spent on debt? You can go back into the kind of mid 2000s, prior to the financial crisis. We were a pretty highly levered economy, a lot of debt in the economy. And when things start to downturn, that can really start to snowball. We've come out of the kind of the pandemic lows where there was just so much extra cash that people weren't worried at all about their debt, and we've kind of rebounded back to pre-pandemic levels, but in no way reaching highs of the last 50 years. We're still in a very stable position. The bottom right panel flows into early delinquencies, something to really definitely keep an eye on. It has ticked up. We are starting to see that. We've highlighted that a few times before. But not at a crisis level of any kind. It's an early warning signal, maybe a flashing yellow light, something to watch, but not something that was be presenting imminent danger. But then on the left, it's just, I mean, the consumer balance sheet in general, and obviously there's plenty of folks who this doesn't apply for, is very strong. We have relatively low debt. We have many mortgages that are in 2s and 3% ranges, very serviceable, lots of home equity. Markets have been very good for folks' 401ks and asset balances and values. And so our consumer balance sheets just look really good, across the economy relative to previous times in history prior to kind of crises. So they were able to weather storms, able to weather recessions and downturns. And then secondly, looking at the corporate strength. So that's the consumer strength, but now looking at corporate strength. And I really love this chart because it shows, the percentage in the gray bars of large cap companies that are unprofitable. The green bars are mid cap, the blue bars are small cap. Now, small cap companies are, always smaller companies, not well
Well, what's
capitalized.
interesting about that? I'm really surprised to see that so long ago, during the tech bubble, it looks like there's several instances where small cap was this unprofitable.
Yeah.
But you see, it
Yeah.
seems to be the dialogue that there's, this is new and fresh.
True. Yes.
Um,
Yes. That's definitely true. It's been pretty stable actually. But look, I mean, back in the tech bubble and even the financial crisis, 30% of large cap companies, like S&P 500 companies, 150 of them, were unprofitable, which is crazy because now, you think that was that's a rare thing, so 7% at currently are unprofitable, in the large cap space. So these companies just have fortress balance sheets, massive free cash flow, and you kind of see that with all of the AI investment. I mean, the CapEx spending of billions and billions and billions of dollars, tens of
so
billions of
Zach,
dollars annually.
I saw a statistic here that's in my newsletter I'm sending out to folks. But it builds on what we talked about in the previous podcast about how the index has changed over time, right? So while we're
Very different.
fearful or we're just aware of earnings, price to earnings ratio, a measure of, valuations for the market, at 22 times, which is higher than the average 18.5 over the last 10 years. But this is so interesting. The constituents of the companies have changed. 36% of the S&P 500 earning companies have profit margins over, Zach, are you ready for this?
60,
60%.
60. Yeah.
60. Insane.
Yeah.
Compare that with like Canadian or Europe. companies, they don't have this tech industry. We're very blessed in this country to have
Yeah.
access to this growth, this excitement. It's a different
Yep.
index.
Not even close. Part of the reason why we've talked about, the US versus international, and there's a reason why there's a discount. But one of the main differences also this time around, the last time we had a CapEx cycle like this, when companies are drastically investing in their infrastructure, was the tech bubble in early 90s with telecom, building out the fiber optic cables and all the towers and all the things that were required for, high speed internet and for cell service, billions and billions of dollars, but it was funded with debt. And so those companies were heavily indebted, they were unprofitable, and they were spending billions. The difference this time around is it's funded with free cash flow. Meta is not taking out any debt in order to, build out their data centers, right? That is free cash
Mm,
flow.
yeah.
And so it's a very different type of environment when you're investing for the future with cash on hand. And that's what these companies are doing, and it just indicates kind of the strength of the underlying companies that make up the U.S. economy. So I thought that was interesting. Looking at
Very.
the kind of recency bias of the past 5 years of returns, I mean, big moves, right? 2020, obviously down 34% to finishing up 18. 2021 finishes up 28. 2022, everything's down double digits. 23 and 24 up, 20 plus percent. Not necessarily normal, right? And so I think some of the recency bias that we're seeing, and if you look at those forecasts, like everyone's predicting, large double-digit returns. I'm actually a little more muted this year. I'm probably more in the LPL camp of, I don't necessarily think it's going to be a volatile year. We kind of look back at, we're just used to it being extremely volatile, right? And big moves one way or the other. So I'm kind of on the other side of that a little bit, just because I think valuations have front run the good news, right? We've kind of pulled forward a lot of the good news. I think that we're going to hit those bars, but I just think that the reactions are going to be muted because it's kind of priced in at this point. So we would need something, kind of gangbusters to pull forward,
So you're
26
saying
and
like maybe
27
5 to
returns.
8%, you think, total return? You want to put a number on it?
Well, look, I think that we do get some volatility. I think we do get that 10% downdraft, and I would probably say we finish flat to low single digits, 3 to 5%, something like that. I'm not expecting
Okay.
another major year just because we've kind of pulled forward a lot of that news.
Well, folks, here
Um,
you have it at home. Discrepancies between your
yeah,
friends at Finance Footnotes. My three and even four great charts, great reasoning. Couldn't move Zach from his cold-hearted position that stocks going to be up, single digits. We'll have to check in next year and see what happens. It promises to be an interesting year as always.
yeah, and look, I think that it'll be. I don't think it'll be a necessarily kind of violent, volatile year. And we've just had 5 years of it. We're just used to it. We're like, oh, it's gonna be up 20. We're gonna get a 20%, drawdown and a big, big bull market, rally and all that. I think we're maybe just a little conditioned for that to happen. I'm always kind of looking for that contrarian position. Um, and I think, and the main reason is we've talked about this before, and kind of the main reason for caution is just valuations. Where valuations are, and they're certainly stretched by most measures, and we've talked about whether or not they're, comparing them to the past is totally appropriate. But nothing's cheap, and so I think that we can kind of spend a year, increase the earnings, grow into these valuations. The PE will come down as the E goes up, right? Um, and also the discount rate, if the rates come down, can make those future cash flows more valuable. So I think that that's just the main reason for caution, right? It's just that there's not too much out there that looks particularly cheap in the U.S. equity market. And if you look at what this is Vanguard's this next slide. Vanguard's 10-year outlook. I think we've looked at this in the past, that they're expecting essentially no annualized growth for the U.S. growth market over 10 years, 0.4 to 1.6% annualized over 10 years forward. So I don't think you want to dismiss this right out of hand. I don't agree with it. I'm in the camp, and we've talked about it many times of how AI will, I personally think, will drive massive productivity gains in the latter half of the decade. But this
Did
is
you see
Vanguard,
that it's
right?
already happening, Zach? I mean, I know you have. So just
Absolutely.
folks at home, last week, U.S. Productivity, which is simply GDP divided by hours worked, government tracks everything, as you know, was up 2% in the quarter. It was the fifth, well, 2% annualized. It's the fifth quarter in a row that is up 2% or more. That's
Yeah,
incredible. That's very
incredible.
off trend. It's very good, and AI certainly is one of the contributing.
I think that's going to accelerate. I think 2025 is going to be a year of like quiet building underneath the surface. Companies that are investing in these tools, learning how to use them, implementing them in their processes. Building out the infrastructure, and then we'll see in 2026 we're going to start hearing on earnings calls like driving millions and billions of dollars worth of efficiencies and new interesting logistical things that companies are figuring out that are going to drastically reduce costs and things like that. I think you'll see that next year and into the remainder of the decade. I feel like 2025 is a year where 24 was like, okay, it's here, right? And it's real. 25, I think, is all of the corporate boards and folks in management teams figuring out how to utilize it and how to implement it into their organizations. So I think it might be a quiet year, but a bubbling under the surface type of thing for that. And then we'll really start to see in the next couple years that it'll drive real growth. So I disagree with this forecast. But I think it's important. This is Vanguard, right? And they are the
Largest asset
largest
manager
asset
in the
manager.
world. So
So for them to say there's going to be no growth at all from U.S. growth equities, essentially, and I'm not actually sure if this is real or nominal. I'm assuming real.
yeah, it would have to be
But
dividends.
still, very, very muted, right? Half of what we've experienced over the prior 10 years. So I think it's important to look at and to note. And then finally, I just wanted to highlight how hard it's been to be an active stock picker in the U.S. equity market, the S&P 500 benchmark. Um, we've had back-to-back years of under 35% of components in the index beating the index. It does look eerily and concerningly similar to 98, 99, back when we had the similar lower percentage numbers. But it's hard to pick stocks when 7 out of 10 are underperforming the index. So it's been a tough couple years for active management. I do think that this will change, as you can see, in history. It does flip back to the other side, and I think 25 could be that year. And to even go towards my forecast for the index, that doesn't mean that the rest of the market couldn't catch up, right? And maybe we do have a year where 6 or 7 out of 10 components actually outperform the index, right? So you could have that switch get flipped where the rest of the market catches up, but that wouldn't necessarily push the index up all that much. So I think that's it's been an interesting time where owning the index has really been the best thing for you in the last 2 years, but this does change.
So So just to highlight one thing here, folks at home, we're looking at a chart here. What is this over the last 50 years or something? Yeah, about 50 years, and it's showing us. But we have to be mindful of the x-axis in all these in any chart that we show you or you ever see
Hmm.
out there in the world. But this is starting at 25% and going to 70%. So it's really zoomed in, and it's giving the illusion that there are many years when active management outperforms large cap, and it's just not the case because if you look, what is this over the last 10 years? There's
Yeah.
been one, two, three, four of the last 10 or 12. So just mindful there. It's hard to outperform the market, as Zach said. So Zach, before I let you go, and before we sign off here, dare we take a guess at the 10-year this time next year? The 10-year Treasury yield.
Well,
It's been up.
10-year treasury,
10-year Treasury yield probably around 4.6% right now. Very highly
4.6.
watched. 4.6 now. Last year, around this time, probably less. In fact, I read it's the first time in history that the Fed has cut interest rates and the 10-year has actually increased by that amount. So it's an inverse
Right.
relationship that doesn't happen. What are we expecting this time next year? Can people finally refinance their mortgage at a lower rate?
Well, no one who's got a 3.5% mortgage is ever going to refinance that at a lower rate, I don't
No.
think. My bet is that rates will be lower because I think that inflation will continue to moderate. I think that the tariff talk will be more talk than actual tariffs. I think that the deportation talk will again, be probably more bark than bite. There's going to be so many court challenges and so much that they're going to try to do that'll get blocked. That I just think that at least in the next
Mm,
12
yeah.
months, it won't have a significant effect on inflation. And I think that the lagging component of shelter, because it just takes so long for that component of the CPI to get to where it actually shows up in the numbers, that I do think inflation will decrease. The Fed will continue to decrease their rates, and I will say 4.25 at the end of the
I think
year.
I think that's great. I think there's a point where we get close to 4.1 in the next year. Of course, it's going to move around. I think 4.25 is a very smart guess, of course. Zach, I like you. I think you're a smart person. Of course, I would say that. But I think in general, I think there's been a lot of concern in the markets about, a possible Trumponomics and how that's going to affect the
Right.
borrowing costs, especially like you said about imports and exports and tariffs. But I think it's a lot of bluster, and I think that interest rates will grind lower throughout the year. So we'll see if we're right here, Zach. Folks, we'll double check here next year at this time to see how our report card was. If you have any questions, please let us know. We're always happy to answer them, and we'll see you in a couple weeks on Finance Footnotes.
Cheers.